Alright, welcome everybody to another video on the After Hours channel. For those of you that don't know, my name is Anthony. I'm a long-term investor with a passion for money, stocks, and personal finance. On this channel, I'll be sharing my insights and experiences as I track the performance of my dividend portfolio. I believe in the power of long-term investing and want to show you what it's like to be a long-term investor in today's market. Whether you're just starting out on your investing journey or you're a seasoned pro, I hope to provide valuable information and resources that will help you make informed decisions about your money and investments. Join me as I share investment strategies, discuss current market trends, and provide tips and tricks for managing your personal finances. Subscribe to stay up to date with the latest from the After Hours channel, and let's build our wealth together. Now, unless you've been living under a rock recently, I'm sure you have seen some of the negative news that has been pushed out day after day. Pulling up the news and we can see quite a few articles on recession. A recession could come sooner on cooling bank lending. If we take a look at some of the key points real quick, we can see Wall Street has been debating whether the economy is heading into a recession for months. The rapid moves in the market after the regional bank failures in the United States has some strategists now expecting a contraction in the economy to come sooner. And lastly, we have economists saying they are ratcheting down on their growth forecasts on the assumptions that there will be a pullback in the bank lending. If you thought that's a one-off article, then we can just pull up this one right here. Again, we have recession potentially could be postponed but can't be completely avoided. This is almost like a backhanded compliment to me. They're saying like, hey, don't worry, the recession could be postponed slightly, but it is inevitable and it is coming, further inflicting that fear into the market. Let's take a look at what JP Morgan has said. It is one of my larger holdings. Already past the point of no return. JP Morgan says the United States is probably headed for a recession as economic engines are about to turn off. Dun, dun, dun. Super ominous. Trying to get that point across like, hey, there is a recession coming. More fear, fear, fear. And of course, if we take a look on YouTube, this is the telltale sign there will be a recession because there are flames in the thumbnails. Now, if you guys are anything like me, this does not deter my investment strategy whatsoever. The only thing that this does to me is signal, hey, there's something going on in the economy, in the market. Take a further look into it and adjust your portfolio accordingly. So in this video, that is exactly what I want to do for you guys. I want to give you guys a few tips and tricks of what you can do starting today in order to prepare for an upcoming recession. Now, this isn't the end all be all in terms of preparing for a recession, but these are some great tips and tricks that you can do now in order to prevent your portfolio from significantly losing a large amount of money or potentially locking in some of those losses. Additionally, it's worth noting that one of the points in here will also set you up financially. So if God forbid you're a part of some of the layoffs that have been happening recently, your family will be good to go. So before we jump into the main part of this video, let's take a look at what we're going to be covering specifically so you can make the determination right now if this video is for you. You're not going to hurt my feelings. So as always, we're going to be doing a portfolio update. After that, we're going to be taking a look at some of my recent buys and sells. Following that, we're going to be jumping into the main portion of this portfolio, and that is the bullet points that you can see on your screen right here. So we're going to be looking at how you can diversify your portfolio, avoid panic selling, consider defensive stocks, and always maintain a cash reserve. And lastly, like all of my videos, we're going to be taking a look at some of the dividends I've received over the last couple weeks and some of my upcoming dividends. So kicking this thing off, we're going to be starting out with the portfolio update. This is going to mark episode 10 of Road to 1 Million. If you guys are unfamiliar with what that is, I'll be tracking this portfolio that you see on your screen right here all the way to $1 million. You guys will be able to see my trades, which are weekly. You'll be able to see the dividends I receive in a six-figure dividend portfolio, and I'll also be giving you guys a heads up on which companies I'll be buying in the future. So as we can see, market is pretty flat today. Not much fluctuation. Portfolio is down $123. If we take a look at the 1 week view to check out the performance, we can see that the portfolio is up almost 3% or $3,500. Taking a look at the 1 month view now, portfolio is up 1.3% or $1,600, so pretty flat. Taking a look at the 3 month view, things are starting to look a bit different. Portfolio is up 7.77% or $9,000. And of course, let's take a look at the year to date because it has been an interesting year in terms of investing. We can see the portfolio is right around the same. It's almost up 8% or right at 8%, and it's at $9,100 in the green. That is why I recommend whatever your investment strategy is, you hold and maintain high quality companies that consistently return money to you as the shareholder. Now, putting my money where my mouth is, you can see all of the companies that I hold in this portfolio right here. I consider all of these companies extremely high quality, and that is why I have put a considerable stake into each of them. I would not introduce a holding into this portfolio if I didn't think it had significant upside or if it wasn't returning money to me as the shareholder. So with the portfolio update out of the way, let's take a look at my recent buys. Coming in at number 1, I bought an additional $295 of Union Pacific. If we move over and we take a look at the dip finder, we can see that Union Pacific is actually 10% below its 200-day moving average. So this is a good indication like, hey, this may be a good buy as of right now, as long as no other fundamentals with the company have changed. Now, of course, this isn't the end all be all to determine whether it's a good time to buy a stock, but like I said, it's a good indicator. For that reason, I've been putting some money into this company and building that position up. Moving back over to the recent buys, again, next buy on the list, and that is an additional $60 of Union Pacific. Few days after those buys, I actually put an additional $1,000 into Union Pacific, so no shocker there. If I feel like one of my companies is on a significant discount or it's on a slight discount and it's a great business, I'm going to be putting my money where my mouth is. I think it's really important to lean into the opportunities you see in the market. Second buy for that day, and that is an additional $1,000 purchase of Visa. This is a company that I recently added to my portfolio, and I made a video about it. So if you want to see my deep dive on this company or you're interested in holding it yourself, take a look at that video. Next on the list, actually bought an additional $24 of Vici Properties. I believe this was a dividend payment, so I just put it right into Vici. Vici is another one of those companies that is at a slight discount in terms of 200-day moving average, so I figured I'd just reinvest that money back into it. This company has been the best performing REIT in the market year to date, and it pays a significant dividend, so I'm trying to build my position as well. Last buy on the list, and that is a $70 purchase of Vici Properties again, and that was a $70 dividend I received from Microsoft, if I'm not mistaken. So with the portfolio update and buys and sells out of the way, let's take a look at one of the first things that you can do in order to prepare yourself and your portfolio for a recession, and that is diversifying your portfolio. Consider spreading your investments across various sectors and asset classes such as bonds, stocks, real estate, and commodities. This can help reduce the overall risk of your portfolio, as different asset trends can perform differently during different economic conditions. So if we're going into a recession, you never know if real estate is going to outperform stocks or if bonds are going to be the best in terms of protection for your portfolio. So as an investor and an adult, I highly recommend taking a look at all the different asset classes that interest you and you feel like you have competency in, and leaning more towards those defensive assets that can maintain and preserve your wealth. Additionally, as I mentioned before, I think it is extremely important for you to own companies that you know have performed well throughout past recessions. This is a great indicator to let you know that, hey, the company that you currently own in your portfolio can easily make it through a recession or a downturn if it lasts a few months or a few years. With that being said, let's take a look at how long a typical recession lasts. If we just do a quick little Google search, we can see that data from the National Bureau of Economic Research shows that between 1854 and 2022, the average recession lasted 17 months. So with that in mind, we should be preparing our portfolios to go through roughly a 1.5-year recession. If your portfolio is mainly made up of individual stocks, maybe it's a good time to invest into some ETFs like SCHD. This is one of my largest holdings. If I'm not mistaken, it's actually my second largest holding. And you can see that right down here. I have almost $22,000 invested into this ETF. and it actually makes up almost 18% of my portfolio. Now, I've mentioned this before, but one of the reasons I hold this in my portfolio, other than the fact that it has consistently performed pretty well over the course of the last 20 years and 30 years, but it's very defensive. As of March, we can see exactly how much of this portfolio is allocated to which sectors. So, number one sector is actually industrials. Second on that list is going to be healthcare. Third on that list is going to be financial, which could be problematic if the banking issue continues to spiral and go out of control. Fourth on that list, we're going to have consumer defensive. And fifth, we're going to be looking at technology. If you guys are going to invest your money into any ETF, I highly recommend taking a look at their top 10 holdings. As we can see, SCHD top 10 holdings actually makes up 41% of their total assets. So if these top 10 holdings do not perform well, the likelihood of SCHD performing well is very low. Taking a quick look at the top 10, we can see they are AbbVie, Cisco, Pepsi, Broadcom, Pfizer, Texas Instruments, Coca-Cola, Verizon, UPS, and lastly, Home Depot. If these are companies you don't want to own, then I don't recommend buying into this ETF. But historically speaking, it has performed pretty well during recessions. Next on the list in terms of how to prepare for a recession, and that is avoid panic selling. Now, if you're new to investing or you've been investing for a few years now, this could be an issue that you face. It is extremely common nowadays for people to sell when the market is going down, further locking in those losses and discouraging you as an investor. When it looks like there are economic headwinds coming down the pipeline and there's a lot of talks of upcoming recessions, this is definitely something you want to keep in the back of your mind when you see some of your holdings going down 20%, 30%, or possibly 50%. As long as you know that the holdings that you have are great companies and the economics have not changed, there is no reason you should be selling that asset. In times of economic uncertainty, it can be tempting to sell off your investments and cut your losses. However, this can lead to missed opportunities for gains when the market eventually recovers. Instead, consider holding your investments for the long term and adjusting your portfolio as needed. So, let's use SCHD as an example again. We just went through their top 10 holdings. We see they have performed pretty well over the course of the last 30 years and any recessions that we have faced. But those top 10 holdings make up 41% of the total assets. If they don't perform well, the likelihood of this ETF performing well are extremely low. So if you want your portfolio to move away from the financial sector, maybe this isn't the best investment for you. Hence the point I made earlier, adjusting your portfolio as needed. Even though I have extreme conviction in the companies that I hold in this portfolio, that doesn't mean that I am married to those ideas and that investment. If anything changes with these companies that I don't agree with or I think is going to be at the detriment to the company itself, I'm going to be pulling my money out of it. And that is no different for my largest holding, which is Microsoft. I have over $30,000 invested in this holding alone, and I am on record saying that this is by far my favorite company in the market right now. I still think that this company is at a discount from where it was, and I do believe it's below its intrinsic value. Again, putting my money where my mouth is, this holding alone makes up 25% of my overall portfolio. Even though I love this company and I think it's an amazing investment, if the financials change with this company or something in the business changes or some of the executives start making decisions I don't necessarily agree with, I will pull my money from this investment just like any other. So if we are going into a downturn, just remember this is an option for you guys. You do not have to be married to your ideas. And more importantly, you do not have to be married to the individual investments that you make. If you're going to sell a company out of your portfolio, make sure that you have a good reason for it and you're not panic selling. Next on the list, and that is consider defensive stocks. Now, we kind of hit on this earlier when we were talking about SCHD, but I just want to go into it a bit further in case you did not understand or to give you a bit more information. Defensive stocks are companies that tend to perform well even during economic downturns, such as healthcare, consumer staples, and utilities. Investing in these stocks can help you provide stability to your portfolio during a recession. If I had to take an honest look at my portfolio and determine which companies would act as that crutch in an economic downturn, I would list them as such. Number 1, SCHD. Number 2, I feel like I could definitely rely on Berkshire Hathaway. 3 and 4 would be Apple and Microsoft. Number 5 would be Union Pacific. And lastly, I feel like I could definitely lean on Visa as the last resort. Now, by no means should this indicate that the other holdings I did not mention would not perform well during an economic downturn. I simply want to highlight the fact that the companies that I have marked and listed on this list are the ones that I feel like would perform best and would have the least volatility in a downturn. As a good rule of thumb, I recommend you go through your portfolio and do the same. If more of your portfolio are allocated to companies you don't think would perform well, maybe it's time to make some adjustments. If you're still watching this video, I just want to say thank you, and I hope this information helps. Last on the list, and that is maintaining a cash reserve. Consider keeping some cash on hand to take advantage of investment opportunities that may arise during a recession. Having a cash reserve can also help provide some financial security in case of a job loss or some other unexpected expenses. So whether we're going into a downturn, a recession, or the world's on fire, I always recommend keeping some money in reserve. Now, if you look up any recommendations, or I do a quick Google search right now, it's always going to tell you, hey, you should have at least 3 to 6 months of savings so that you can provide and maintain the same lifestyle you currently have if you lost all sources of income. If we look at the average income in the United States, we can see it's roughly $63,000. And this is personal income. This isn't including families. The average family or household income is actually $87,000. So if we break down the personal income real quick, that would average out to roughly $5,200 per month. Now, this obviously isn't including taxes, but it's a fun little game to just see how much you would need to maintain your same lifestyle if you did lose all sources of income. Now, if we're going based off of the recommendations of many financial analysts and financial advisors, and they say you should have roughly 3 months of savings or 6 months, you're going to need roughly $15,000 saved up. Now, if you do have a family and your significant other have multiple income sources and you're making roughly $87,000, well, that's going to equate to roughly $7,200 per month. We times that number by 3, and you're going to need roughly $21,000 saved up. Or at least that is a good recommendation and a good rule of thumb. Now, if this seems overwhelming to you, believe me, you are not the only one. This is a significant amount of money, especially when we have so many other expenses that we have to rely on and pay every single month. So for that reason, I want to end this video off by saying, yes, it's always good to maintain a cash reserve. But the main thing that you need to be focusing on if we are going into a downturn, and that is the amount of money you spend on other things. Take a look at your expenses, sit down with your significant other, and really determine what is a necessity. Now, if this means cutting back on eating out just to save some money, I highly recommend doing that. Maybe you're going to have to start canceling some subscriptions just to save a little extra cash. Now, the topics that we covered today may not specifically pertain to the situation that you're in, and that's totally fine. Take what you need from this video that we discussed and implement it into your life. If you think something would work better than another, feel free to use it. And the final point I'm going to make about upcoming recessions is do not let fear overcome you and dictate the financial decisions that you make. And lastly, to end things off, let's take a look at my upcoming and recent dividends. So starting at the top, if we take a look at pending dividends, we can see that Union Pacific is going to be paying me roughly $27 on March 31st. As for recent dividends, we got Microsoft coming in at number 1. They paid me $70. I took that $70 and bought more Vici properties, as you guys saw earlier. Coming in at number 2, and that was $24 from Jeppy. That $24 was also reinvested into Vici. And lastly, on February 24th, Starbucks paid me $60. This is going to conclude episode 10 of Road to 1 Million. If you have any questions about the topics we covered today, feel free to leave your questions in the comment section down below. If you have any questions about my holdings or potentially one of your holdings and want to see a deep dive into it, let me know as well. And of course, if you guys want to stay up to date with the companies that I'm buying over the course of 2023, don't forget to like and subscribe. I will see you in the next one. Take care.